our first topic for tonight is all about real risk reward. Okay, before we define what true risk reward is or real risk reward is, let's start off and look at the traditional risk reward. Okay, it's a ratio that gets thrown around quite commonly. I think you all know what it is, so I'm not going to spend too much time defining it. But in essence, it's the potential profit versus the risk or the potential risk that you're going to take to get that profit. Okay, and we use it to ultimately assess whether a trade is worth taking based on the potential reward relative to how much risk we have to take. Okay, that in a very basic nutshell is what risk reward is. Basic example: if we had a risk reward ratio of 3-to-1 and we had a stop of $300, effectively we'd be looking for a $900 target. Okay, so that's in essence a very, very basic sense. Now, the first flaw with using a traditional RR is we are using hypothetical scenarios. Okay, in other words, if I place a stop somewhere and ultimately I have a 3-to-1 risk reward, I'm then going to place a target at a predefined area. Okay, and ultimately it's all hypothetical. So none of it is actual, none of it is real. It's all hypothetical. And you'll understand in a moment why this is a massive flaw. Now, for this ratio to have any value, okay, to be able to use a traditional risk reward, you have got to have a consistent execution methodology. And a way to think about this is if you are developing an algorithmic strategy, then this ratio is perfectly good to use. Why? Because you are executing it in the exact same way every single time. The stop and the target are predetermined, predefined, and they're always in the same position. Okay, and you can go and back test that, you can go and forward test that, and you can lean on that risk reward to give you insight. The reality is that most of you are not developing algorithms. Most of you are discretionary traders. Okay, so ultimately, unless you're going to be consistently executing something, you don't want to be leaning on a traditional risk reward. You rather want to use a real risk reward. And I'll explain to you what this is in a minute. Now, like I said, for active day traders, using the hypothetical ratio, and I was having this idea of I'm going to hypothetically run my trade for 15 ticks. It just doesn't add any value. Okay, the reality is what tends to happen for most traders is when they get into a trade, they've got this idea of they're going to have a 3-to-1 risk reward. And ultimately what that does is it enforces a bias and an expectancy in their mind. And what happens is they're kind of waiting for this 3-to-1. They're watching the trade get to that 3-to-1. It never really gets there. They end up taking a scratch or maybe a small win or a small loss. And then they never really understand why they're not developing any kind of, sort of forward momentum. Okay. Now, most traders, I'm talking about typical trading, how they would typically enter a trade is they would have an idea of a stop and target. So they look at the market, they say, okay, I'm going to enter this trade. I think it'll go here and I'm going to put a stop here. What happens in reality is the complete opposite. Okay, typically traders will never take a trade to a hypothetical target. Okay, why? We do not have control over how far the market will go or where it will go. Okay, we have an idea of where we would like it to go. We hypothetically think it can go there, but in reality, we're never going to take it there. So to use and lean on on a normal risk reward is very, very misleading because we're factoring in hypothetical targets, which we never actually end up achieving. Okay, so what's the first thing to take away from this topic? Unless you're building algorithms, the traditional RR is a waste of time. Okay, it's a metric that's ultimately just going to put a bias in your thinking. It's going to keep you in trades for far too long because you're focusing on it going to a certain price, as opposed to watching objectively when the market gets to a certain point or does something specific, exiting based on objective facts. Okay, so why is it so popular? Why do traders like to lean on the traditional risk reward? Well, because it gives you a sense of control and it makes you feel comfortable in taking the risk. Think of it like this. If you had a really good trade idea and you could make $1,000 on that trade idea and all you had to do was risk $100, you will take this trade every single day. Why? Because you've created a coping mechanism to justify taking the risk. The problem is the hypothetical target is an illusion, and it's a very dangerous one. Okay, I don't know a single professional trader that looks at a risk reward of a trade prior to executing it. Not one single trader. I've never met a trader that says, oh, I'm going to take this trade. I'm going to take a 5-to-1 on this trade. I do not know a single professional trader that thinks that way. Okay, let me explain to you how a typical trader or a typical professional trader's process looks like. Right? Think of this as a chart. Okay, trade idea, trade strategy I've got. The first question a trader is asking himself is, where is my trade strategy invalid? Okay, that's the first question asking. In other words, where am I placing my stop? That's my first concern as a professional trader. The next thing a professional trader is asking himself is, what do I expect it to do? Okay, what is my set of expectations? Okay, that's the second thing. And then the third thing that a professional trader is asking themselves is, what do I not want to see that's ultimately going to make me exit the trade? Okay, and those are the three things that a trader is leaning on. At no point is a trader thinking, oh, I'm going to run it for 3 times what I'm willing to risk. No ways. At no point. What a trader is looking for is, what are those objective characteristics? What's those objective facts coming from the market that ultimately will lean and tell me and inform me that actually, you know what, this trade has now run its course, the opportunity's run its course, it's running some liquidity, now's the time to exit. That's the kind of things that traders, professional traders, are focusing on. Okay, so for discretionary traders, you need to use something called real risk reward. Okay, again, it's very similar to a traditional risk reward, except we get rid of this idea of looking at hypothetical scenarios. And instead, what we're looking at is what we actually take in terms of profit versus what we risk. Now, why does this work well? Let me explain it to you. Like I told you, the professional trader is never making decisions off of a risk reward strategy. No, the risk reward is just simply giving them an idea as to what a trade could hypothetically do, right? So if a professional trader is using this statistic called real risk reward, what they're actually leaning on is what actually they're taking on a trade versus what they're actually risking on a trade. Okay, and you can see this comes from one of the Tradelo traders. What you can see ultimately is that this trader risks on average $280 per trade. Okay, and on average, he's winning $350 per trade. Okay, so this gives the trader an idea that ultimately he's got a real risk reward of around 1.12. It's not hypothetical. It's not he would like it, he would like to make $500 for every $280 he risks. No, it's he's taking, every time he executes this scalp trade, he's taking 1.12 times what he risks. Okay. Now, why that matters is because what it allows you to do is understand what actually happens in your trades, not what you hypothetically want to happen. Okay, and what that means is that you're exiting trades more likely where the market has reached that maximum profit potential. Okay, this is why professional traders focus on real risk reward as opposed to the traditional ratios that most traders use. Okay, now just looking, I'm not going to go through any of the other factors. Yeah, you can look at that later on. But very, very important is that when this trader is executing his scalping strategy, his profit expectations are grounded in reality. Okay, because what he's doing is he enters the trade. The first question he's asking himself is, where's this trade invalid? The next thing he's doing is he's trying to understand what are these set of expectations he needs to be aware of. And straight away, you can see that this trader has an expectation that he's roughly going to get about 1.12 to 1 risk reward. Okay, so he's looking more or less to achieve the same amount he's risking to the upside. Okay, and then he's watching, he's observing as he gets to 1-to-1 risk reward, as he's getting to that 7-8 price tick winner, he's watching the market for those very specific characteristics, and bang, he sees them, exits the trade, and at that point captures the data. Okay, that's the key difference between how professional traders assess the real risk reward versus the traditional ratio. Now, very, very important. Okay, for me as a mentor, when I deal with specific traders, when I'm working with them, okay, when they've got data like this, when I can have a look and say, well, look, you've got a monthly frequency of 53 times, you've executed this trade 65 times, your trade expect, when I've got this data at hand, I can then actually work quite closely with the trader because I can point out where work is needed. Okay, I can show them where there's marginal gains. Our discussions don't center around, you need to take better RR. No, it's got nothing to do with that. Our discussion centers around how are you entering the trade? Where are you placing that stop? What are you looking to achieve in terms of, getting out of the trade? What are those observations that will make you exit the trade? So everything we discuss is based on inputs. At no point do we say, oh, you need to have a higher target, a higher RR. Okay, that never factors in the discussion because it's pointless to discuss it because we do not have control over the targets. Okay, what we can control is where do we place our stop? What we can control are what are the objective facts that will allow us to get out of a trade. We can control those things, and that's where we focus our energy. Okay, so one misconception that's very important to do away with, okay? To make more money as a trader, you don't change your strategy. You don't go and say, oh, I need to take bigger RR targets. That's rubbish. And it's something that unfortunately gets missold. It's this idea of you need to take bigger RR. You need to take 2-to-1, 3-to-1, 5-to-1. That's absolute rubbish. If you want to make money as a trader, you have to increase your bet size. Maintain the same process, increase your bet size. Okay, you do not control the market outcome. So what you cannot do is you cannot say, oh, I'm going to start targeting a 3-to-1 risk reward instead of 2.5, because the market determines the target. You determine the stop, you determine the position size. So you have to control what you can control, which is stop and position size. You want to make more money, you have to manage your risk optimally, because this will allow you to take bigger position sizes. Okay, you never ever change the process of making money. You simply bet bigger on an already profitable process. Okay, like in this example, this trader can push the boundaries now. He can start increasing that position sizing. A little bit later on, I'll show you how you automatically do this. But this trader can take the scalping strategy and he can start to push it now, where his average win now will become 500 and his average loss will become 380. And steadily, he'll start to make more money. This trade expectancy will increase over time. And over time, as he does more frequency times by his trade expectancy, he'll make more dollar P&L. Okay. Now, very, very important. Like I said, for this trader to get bigger, he won't suddenly start scalping bigger targets. Okay. He's not going to suddenly go, oh, I need to take 20 tick winners instead of the usual 7-8 tick winners. Okay. He'll find a way to tighten his stops. And this is what we deal with quite extensively. When a trader is looking at his strategy, we focus very heavily on where is he placing that stop? Why is he placing it? Can he find those additional ticks where he can tighten up that stop? Because once he's optimized his stop placement, then ultimately his position sizing increases every single time. Okay, now, one final note. What is a good RR for a trade strategy? Because I'm guessing a lot of you are thinking this. Well, if he's talking about RR and a real risk reward, what is a good real risk reward? Okay, the reality is it depends on a number of factors. So there's no real hard, fast rules. But what I do recommend and what I said to this trader is ultimately he can begin the process of increasing his position size because his risk reward is more than one. Okay, if your risk reward, your real risk reward, not hypothetical, if your real risk reward is greater than one, you can start to increase the position sizing because you most likely have got edge. Okay, and again, like I said, it also depends on your win rate, of course. There's a number of other variables, but by and large, so long as your real risk reward is greater than one, ultimately you can begin the process of increasing the position sizing. Okay, if you can actually deliver 1.5 real risk reward over time, in other words, if you capture every single trade you do, every single one, and ultimately on all your trades, okay, you taking 1.5 times what you risk, you can make some really decent money as a trader. Okay, just to give you an idea, you do not need 2-to-1, 3-to-1, 5-to-1 to make really good money. 1.5 real risk reward to one is really good.